Hi everyone and welcome. Today, we're diving into the world of accounting, but don't worry, we're keeping it simple. We'll learn a simplified method for recording financial transactions using only three columns: assets, liabilities, and capital. This approach will help you grasp the fundamental accounting equations. Assets is equals to liabilities plus capital. We'll walk through the process step by step using real-world scenarios and a handy table to illustrate everything. Finally, we'll create a balance sheet to see the final results. Let's get started. Before we jump into recording transactions, let's quickly review the core concept, the accounting equation. It's the foundation of everything we'll do today. The equation is assets is equals to liabilities plus capital. But first, let me introduce the definition of assets, liabilities, and capital, or the owner's equity. Assets. These are what your business owns, like cash, equipment, and inventory. Liabilities. These are what your business owes to others, such as loans and accounts payable. The capital, or the owner's equity, represents the owner's investment in the business and the accumulated profits. Every transaction affects at least two of these accounts, and the equation always needs to remain balanced. Think of it like a seesaw. If one side goes up, the other side must adjust to keep it level. Now, let's learn how to record transactions. We'll use a simple system focusing on the accounting equation. We'll need a transaction log or table with these columns: date, description, assets, liabilities, and capital. Let's look at an example. If you invest 1,000 pesos of your own money into your business, your assets or cash increase by 1,000 pesos, and your capital or the owner's equity also increases by 1,000 pesos. Assets, which is 1,000 pesos, is equals to liabilities plus capital, which is also 1,000 pesos. Now, let's say you buy supplies for 200 pesos. Your assets or cash decrease by 200 pesos and your capital decreases by 200 pesos, reflecting the expense. Again, the equation remains balanced. Now, let's put this into practice with a series of transactions. We'll use a table to record 15 transactions, each with a short scenario. Pay close attention to how each transaction affects the balance of the accounting equation. Let's look at an example of PMI Company. Their first transaction occurred in September 1st, where they invested 1,000 pesos in their new business. This caused an increase in asset and also in capital. On September 2, the company purchased 200 pesos of office supplies that causes their assets to decrease by 200 pesos and also a decrease on capital by 200 pesos. On September 5, receiving a 500 from first client increases in assets and also in capital. September 6, they paid 100 pesos rent for office space, which decreases in assets and also in capital. On September 7, they secured a 2,000 business loan that increases in assets and also in liabilities. The purchase of 500 pesos of equipment resulted in decrease of asset by 500 pesos and a decrease in capital of 500 pesos due to the expense. Paying 75 pesos for advertising on September 11 decreased in assets and also in capital. On September 15, the company received 800 pesos from another client, which increased both in assets and also in capital. On September 17, paying 200 pesos for utilities decreased in assets and also in capital. On September 18, a 500 peso loan payment decreased both asset and also liabilities by 500, leaving capital unchanged. As we can see in September 19, earning 300 pesos from services increased both assets and capital by 300 pesos. On September 20, the company purchasing 150 pesos of inventory decreases the assets and also the capital by 150 pesos. By September 25, Receiving a 400 pesos from a repeat client increased both assets and capital by 400 pesos. Paying 100 pesos in employee wages decreased in assets and capital by 100 pesos on September 27. On September 30, receiving 250 pesos in interest income increased both assets and capital by 250 pesos. That is all for our 15 examples of the transactions. Finally, let's create a balance sheet to summarize our financial position. A balance sheet shows your assets, liabilities, and capital at a specific point in time. We'll use the final figures from our transaction log. You have to make sure that you've totaled all the transactions before creating your balance sheet. This contains the assets, total assets, liabilities, total liabilities, equity or the capital, the total equities, and the total liabilities and equity. And there you have it. By using this simplified method, you can easily track your business finances and maintain a clear understanding of your financial health. Remember, accurate record keeping is the key to success. Thanks for watching!